Okay, so you guys have made it. This is the end of financial accounting. Chapter 12, reporting and analyzing cash flows. Here are our learning objectives for chapter 12. So we'll look at the difference between the different activities, operating, investing, and financing, and then we'll ultimately get to a place where we're preparing the statement of cash flows. All right, so the purpose of statement of cash flows, it explains how the cash balance changed from one balance sheet to the other. How does a company receive its cash? Where do they spend it? Why do the income and cash flows differ? Is there a shortage? And how much is paid in dividends? Importance of cash flows. So it helps users decide if a company has enough cash to pay its debts. It also helps users evaluate the company's ability to pursue unexpected opportunities, how the managers plan day-to-day operations, and where the managers make their long-term investment decisions. All right, so the measurement of cash flows. So cash equivalents are short-term, highly liquid investments, anything that's readily convertible into cash and needs to be sufficiently close to maturity so that the market value is unaffected by interest rate changes. Okay, if those are all true, it's a cash equivalent. All right, let's talk about the different categories of activities: investing, financing, and operating. So we've talked about this before, I think way back to the beginning of the class, but the classification of cash flows, you have three sections. You have the operating activities, financing activities, and investing activities. Here's some examples of operating activities. So operating activities, you have inflows and outflows. So examples of inflows would be cash sales from customers, dividend, uh, receipt of dividend revenue, collections on credit sales, receipt of interest revenue. Cash outflows would be things like paying salaries and wages, paying operating expenses, paying taxes and fines, paying interest owed, paying suppliers for goods and services. Investing activities would be things like cash you receive from selling any property, plant, or equipment, or collecting on principal on notes receivable, um, selling intangible assets, selling long-term investments, selling short-term investments, selling or discounting of notes receivable. Those would all be inflows. Cash outflows would be if you buy property, plant, and equipment, you buy intangible assets, you loan money in return for a notes receivable, you buy short-term investments or buy long-term investments. Okay, those are all investing activities. So they're typically the transaction and events that come from the purchase and sale of long-term assets. Okay. All right, financing activities include transactions and events that affect long-term liabilities and equity. So financing activities would be things like issuing common stock or preferred stock. Reissuing treasury stock would be cash inflows. Um, Issuing short and long-term debt, so notes and bonds payable. Contributions from owners would be cash inflows. So you either finance your company through debt or through equity. So anything that's debt or equity related will typically be a cash flow from financing activities. Cash outflows would be things like paying dividends to shareholders, purchasing treasury stock, paying withdrawals to owners, paying off short or long-term debt. So if you pay down your notes receivable or your bonds payable, or your notes payable, I'm sorry, or your bonds payable, that would be a cash outflow for financing. All right, so some investing and financing activities don't affect cash flows. So one example of that would be the purchase of a long-term asset using a long-term note payable. So if you said, I bought a building, company ABC bought a building for $800,000 in exchange for a note payable, no cash activity happened there, right? You got a building and you got a note. It doesn't affect the current period cash. Okay. Um, so other examples of non-cash activity would be retirement of debt by issuing stock, conversion of preferred stock to common stock, leasing assets in a capital lease transaction, purchasing long-term assets by issuing a note or bond. So that was the example that we gave. Exchange of non-cash assets for other non-cash assets, and then the purchase of non-cash assets by issuing debt or equity. All right, so let's talk about preparation of the statement of cash flows. So the format of the statement of cash flows, this is the direct method. So in the first section, you have your cash flow from operating activities. So you would list the individual outflows and inflows, sum them up. It's either net cash provided by if it's positive or net cash used by if it's negative, operating activities. And then the same would be true for your investing section and your financing section. You add up all your subtotals. These guys here. And then you get your net decrease in cash. Add that to your cash balance at the beginning of the period, and it will compute for you the cash balance at the end of the period. Okay? All right, so how do we prepare the statement of cash flows? Well, there's 5 steps. First, you compute the net increase or decrease in cash. Then you compute the net cash from or for operating activities. Then the same from or for investing activities. Then you compute the net cash from or for financing activities. And then you compute the net cash from all sources, and you prove it by adding it to the beginning cash to get the ending cash. So the thing about the statement of cash flows is you know what your cash was at the beginning of the period because you had a balance sheet, right? You know what the cash was at the end of the period because you have another balance sheet. And so the difference between those two should be your net cash used or provided by all of your activities. But if the sum of the net cash provided by or used in all of your activities doesn't equal that change, that means you got a problem. Okay? All right, so analyzing the cash account. So the cash account's a natural place to look for information about cash flows from the activities, right? So let's see. Computing the net increase or decrease in cash is simple, but it's a very important computation. So it's equal to the current period's cash balance minus the prior period's cash balance, right? So in this case, our ending cash balance was $17,000. Our beginning cash balance was $12,000. So your net cash provided by, in this case, because it's an increase of 5, is what the sum of all of your activities should equal when you're done with your cash flow statement. Okay. I don't know what's going on with my highlighter here, but 17,000 minus 12, you have a net cash provided by of 5 over the period. So the second approach to preparing the statement of cash flows is to analyze the non-cash accounts, and then it draws on double entry accounting. And so in sum, all of the cash transactions eventually affect non-cash balance sheet accounts. So we can determine the cash inflows and outflows by analyzing the changes in the non-cash balance sheet accounts. So what this slide is trying to show us is that by using the accounting equation to show the relationship between the cash account and the non-cash balance sheet accounts. So if we start with the accounting equation, assets equal liabilities plus equity. Really, you can say cash plus non-cash assets equals liability plus equity, right? Then you could say in line 3, if you subtract the non-cash assets from both sides of the equation, so it's almost like the algebra problems we were doing way back when. If you subtract non-cash assets from both sides of the accounting equation, then it goes away. Where's my pen here? It goes away here, right? Oh, red would be the better color so you can see it. Hold, please. So now, oops, good grief. Okay, so our non-cash assets disappeared here, right? And we subtracted it from over here. So then basically what you could say is that your changes in your cash account are equal to the changes in your non-cash account. So I don't know if that makes any sense to anybody or not, but if it does, use it. If it doesn't, ignore it. Okay? All right, so information to prepare the statement of cash flows comes from 3 places: comparative balance sheets, your current income statement, and then some additional information. Okay, so they want us to classify the cash flows as either operating, investing, or financing in this example. But let's go through a couple reminders first. So operating activities are the day-to-day cash receipts and disbursements that determine net income. So it's generally current asset and current liability activity. Investing activities are the disbursements, cash receipts and disbursements that generally relate to the purchase and sale of long-term assets and the non-operating short-term investments. And then financing activities are cash receipts and disbursements generally related to long-term liabilities and equity and non-operating short-term debts. Okay? So an easy way to remember this is to think about the balance sheet. So cash flow related to the current items is generally operating. Cash flow related to investing is generally what's going on in your plant assets. And then cash activity related to financing is your long-term liability and equity. Okay, these are general statements. Okay. Okay, so now let's classify each of the following in the appropriate buckets. And so to make this easy, because they give us all the answers at once, I believe, let's highlight our operating activities in green, our investing activities in yellow, and how about our financing activities in blue? All right, so first let's look for all of our operating activities. So we know that when we pay run-of-the-mill expenses for operating our business, that those are financing activities. So we know that cash payment of wages would be a financing activity, or I mean an operating activity, sorry. The run-of-the-mill expenses to pay for the day-to-day cash receipts and disbursements that determine net income is typically what falls under our operating activities. And so we know that wages falls under the, it's one of the cash receipts or disbursements, in this case disbursement, that is used to determine net income. So we know that that's an operating activity. We know that cash paid for utilities is also an operating activity. And let's see, any other expenses? And we know that cash collections from customers is an operating activity. Okay, so those are all stuff, that's all stuff that happens in the run-of-the-mill day-to-day operations of your business. So let's see, is there anything else that would be an operating activity? So when you're receiving interest or dividends on investments that you make as a company, that's considered to be a day-to-day cash receipt or disbursement, because that ultimately is helping to determine net income, like interest income or dividend income. So both cash received on investments and receipt of cash dividends from investments are both considered to be operating activities. Okay? So let's see if we're right here. B, D, E, G, and J. That's right. Okay. Let's see if we can pick out our investing activities. So cash receipts and disbursements generally related to the purchase and sale of long-term assets. So let's do yellow for those. So in letter A, we're buying long-term equipment, right? So that one's going to be a investing activity. In letter H, we're paying cash to acquire investments. That will also be an investment activity. And in letter K, we're selling investments. So that's going to be an investing activity as well. Okay. Whoops, I didn't want to give you the answers, but I guess we know what remains, right? So anything that's debt or equity related, when we issue stock, that's financing. When we issue note payables, or when we receive note payables, that's financing. When we retire debt, it's financing, and when we receive a bank loan, it's financing. Okay? So hopefully you found that to be helpful. All right, so cash flows provided by or used in operating activities are reported using one of two methods. So you can prepare the cash flow statement either using the direct method or the indirect method. The methods really only apply to the operating activities section. So the financing and the investing are the same either way you choose. So the direct method is what we just kind of did. You go through and you say cash flow from operating activities and it's received or paid by, right? And you compute what the net cash provided by operating activities is. Okay. The other way is to start at net income and then you make adjustments to add back or subtract non-cash activity or increases or decreases in your various balance sheet accounts. Okay. All right, compute cash flows from the operating activities using the indirect method. So let's put put an example to that and see how it works. Okay, so what they're asking us to do in these next couple slides is to prepare the indirect method illustration of cash flows. So what they've provided us here on this slide is the balance sheet, some additional information, and the income statement. And from these three pieces, they want us to put together the statement of cash flows. All right, so when we're applying the indirect method, we're going to start with our net income of $38,000. And then we're going to make adjustments that don't affect cash. And then we're going to add the changes in the current assets and liabilities to calculate our net cash provided by operating activities. So if we're starting at net income, what we know from the previous slide, that what we know was subtracted from our revenue to get net income was depreciation expense and book loss on sale of plant assets. Well, both of those items were subtracted to get to net income, but they're not cash related because they're just calculations. They're just accounting numbers. When you book depreciation expense, there's no change in cash. When you record the loss on the sale of a plant asset, there's no cash. It's the difference typically between the cash you receive and the net book value of the asset that you sold, right? And the net book value is the effect of the cost less the accumulated depreciation, which is a non-cash item. So we're going to add both of those back. And then we had gain on retirement of notes. Well, the book gain and losses on anything are typically non-cash activity. So you need to undo the effect that those had on computing your net income because net income is your starting point. So that $38,000 was inclusive of $24,000 of expense that's not cash related. So I'm going to add it back. That net income was also inclusive of a loss of $6,000 that isn't cash. So I'm going to add back the $6,000 loss. It also was inclusive of a $16,000 gain that really wasn't cash. So I'm going to remove the effect of the gain by subtracting it. Okay? And then we go through our current asset and liabilities and we pick out the cash effect or report the cash effect of the change in those accounts. So our accounts receivable increased. Well, if our accounts receivable increased, that means that we haven't received cash, right? If your balance in your account receivable is increasing, that means more customers are paying on credit, and therefore you have less cash. And so the change in accounts receivable, the increase, is a reduction in your cash. Your increase in inventory, the more inventory you buy, the less cash you have, right? Because you typically debit inventory, credit cash. So as your balance in your inventory is increasing, that means your cash is decreasing. So the increase in your inventory account is reported as a negative or a reduction in cash. Increase in prepaid expenses, again, when you have a prepaid expense, you debit prepaid expense and you credit cash. So every time your prepaid expense account increases, your cash decreases. So that increase in prepaid expenses is reported as a reduction or a negative in cash. Your decrease in accounts payable is a decrease in cash. So if you pay down your accounts payable, what are you doing? You're debiting accounts payable and you're crediting cash. So decreases in accounts payable are also decreases in cash. Decrease in interest payable is also a decrease in cash, works the same way. And then an increase in income tax payable is an increase in cash. You haven't yet paid it, right? So you have more money. And then you add all those up and you get net cash provided by operating activities of $20,000. Okay. So adjustments for income statement items that aren't affecting cash. So expenses and losses with no cash outflows are added back, and revenues and gains with no cash inflows are subtracted. So that's what we talked about in the previous slide. Okay, so this table may or may not be helpful for you, but this is a slide that I would bookmark if it is helpful. So it explains how to treat non-cash, uh, a change in non-cash, current assets or liabilities in the operating section. So um, if you have current assets, so increases in current asset balances during the year are subtracted from net income, decreases are added. So they're opposite. So if you have an increase in an asset account, it's a negative on your cash flow. Whereas current liabilities, if you have an increase in a current liability, it's an addition to cash flow. And if you have a decrease, it's a subtraction. So those work the same direction, whereas current assets don't. So this might be a slide that you want to memorize. Whatever your change in your balance is, increase or decrease, this tells you what to do, whether you add it or subtract it on your cash flow statement. Okay? All right, so this is just another way to explain that same thing. So decreases in current assets are added to net income. Increases in current assets are subtracted. Increases in current liabilities are added. And decreases in current liabilities are subtracted. So that was the explanation that I went through for all of these on the previous slide. Okay. All right, so what we're trying to summarize here is common adjustments to net income when computing net cash provided by operating when you're using the indirect method. So typical adjustments can be adjustments for operating items that are not providing or using cash. So you add back your non-cash expenses and losses. So expense examples for that would be like depreciation, depletion, amortization, or losses from disposal of long-lived assets or retirement of debt. And then you subtract non-cash revenue and gains, so gains from disposal on long-term assets and from retirement of debt. And then the adjustments in your current assets and current liabilities, same thing here, just presented differently as what we've been discussing the last two slides. Decrease in non-cash current operating assets are added. Increase in non-cash current operating assets are subtracted. Increase in current operating liabilities are added, and decreases in current operating liabilities are subtracted. Okay. All right, so a company's current year income statement and selected balance sheet data is presented. They want us to prepare the cash flow for operating section of the statement using cash flows from the indirect method for the current year. All right, so our general format is net income plus adjustments to reconcile net income to net cash provided by. So we're going to take income statement items that aren't affecting cash. They go the opposite direction. We're going to add any expenses that don't require cash, subtract any revenues that don't provide cash, and then we have adjustments for gains or losses related to long-term accounts. Opposite direction, add the losses, subtract the gains. Then we have our changes in our current assets and current liabilities. Adjust for changes in current operating assets in the opposite direction. Add decreases, subtract increases, right? Then we make changes for then we add the changes for current operating liabilities. Those go in the same direction. So we add increases and we subtract decreases. And then we get our net cash provided by or used by. Okay. All right. So let's start with net income. So we have net income of $20. They tell us right here, right? Oh, I don't like that color. Hold on. All right, we have net income of $20. That's where we're starting. Oh, good grief. Let's try that a third time. Oh, wrong color. Goodness. Okay. All right. I have my highlighter and my yellow color. We start with net income, $20. Then we have to make our adjustments to reconcile net income to the net cash provided by operating activities, right? So we're going to add back our depreciation expense because that's not a cash related item and our income was originally reduced by it, right? And then they don't have any gain or loss on sale there, so that's the only non-cash item. Then our accounts receivable, current year's 12, prior year's 10, the change is 2. Well, if our accounts receivable is increasing, that means more customers are paying us on credit, which means we have less cash. So we're going to subtract our increase in our account receivable by 2. We have $6 in our inventory. Prior year was 9, so our inventory decreased by 3. Well, that means we're buying less inventory, which means we're spending less cash. So that's an increase in cash of 3. Decrease in accounts payable. We started at 7, or we started at 11, now we're at 7. We had a decrease in accounts payable of 4. That means we're paying our accounts receivable down, and we do that with our cash, right? So our decrease reduces our cash. We had salaries payable of 8. It was 3. So we have an increase in salaries payable of 5, which means we haven't yet paid it, haven't yet spent our cash. So it's increasing our cash. And we have an increase in interest payable of 1. We add that, okay? If you add them all up, it's $33. So we have net cash provided by operating activities of 20, net income plus 33, total of 53. All right, determine cash flows from investing and financing. So 3-step process. Identify the changes in investment related accounts. You can explain them using T accounts and reconstruction entries, and then you can report the effect on the cash flow. Okay, so information about Genesis transactions provided earlier reveals that the company both purchased and sold plant assets during the period. So both of the transactions are investing activities and are analyzed for their cash flow effects in the section. So step 1 in analyzing plant asset account is its related depreciation account is to identify the changes, right? So plant assets increased by 40,000, 250 minus 210. And accumulated depreciation increased by 12, 48,000 minus 60,000. Okay, the second step is to explain the changes. So items B and C of the additional information that was on that earlier slide discussed the plant assets. So what they told you in that additional information is I think that they had sold the plant for $2,000 cash. I think they might have told you it had a $6,000 loss, but I can't go backwards as I'm recording, so we're going to pretend like we remember what that slide said. So items B and C from that additional information a couple slides ago discuss this information. So that's where you get it from. And then recall that the plant asset account is both affected by purchases and sales, right? And its accumulated depreciation account is normally increased from depreciation, and it's normally decreased from the removal of accumulated depreciation when we sell an asset, okay? So to explain the changes in the accounts and to identify the cash flow effects, we just prepared the journal entries that would have happened because we have enough information to be able to do that. So when we prepare the reconstructed entries from the prior transactions, here's what we come up with. So in item B, they told us that Genesis purchased the plant assets for $60,000 by issuing a note. Well, what happened probably was they debited plant assets for 60 and they credited notes payable, right? Then in item C, they told us that they sold those assets. They sold assets costing $20,000 with accumulated depreciation of 12 for $2,000 cash, resulting in a $6,000 loss. So if we were to journalize that sentence, we got $2,000 cash, so we would increase cash by 2, debit 2,000. If we're selling the asset, we're removing 12,000 of depreciation off our books. We do that with a debit. And we're removing $20,000 of plant assets off our books, and we do that with a credit. So we know all these pieces, and they tell us that we have a $6,000 loss. So if we plug in our $6,000 loss, our debits equal our credits, and the entry looks legit, right? So then we also want to construct the entry for the depreciation expense from the income statement a couple slides ago. So they tell us that, I think they told us that there were $24,000 of depreciation expense. So we're just going to record depreciation expense of 24 and accumulated of 24. So we're reconstructing the entry to figure out our cash activity, right? So that's step 2. Then in step 3, the $60,000 purchase that they described in item B a couple slides ago, where we bought plant assets by issuing the note, right? That's a non-cash investing activity. And so it's reported in the note or in a separate schedule to the statement. So item C reports that Genesis sold the plant assets costing that $20,000, right? With $12,000 accum, the entries we just reconstructed. So if we post all of those entries to our T accounts, we've got our original $48,000 in accumulated depreciation. Where is my highlighter? $48,000. We know that we have depreciation expense of $24,000. That increases our accumulated, right? So it gets posted to the right side of our T account. And then we sold $12,000. That's reducing our accum. The accumulated on the asset we sold was $12,000. So the sale, we're going to reduce our accum for 12, and that's how we get to our 60, right? And then our plant assets, we started at 210. We purchased 60, they told us, but we also sold 20. So that's how we get to the 250. So the activity, this is the activity that makes up that $40,000 change in plant assets, and this is the activity that makes up the $12,000 change in the accumulated account. Okay, so, but we looked at all of those entries that we had recorded on the previous slide or reconstructed. There was only one cash line, right? And that was the cash that you received from the sale. So that belongs in your investing activities. But then you also have non-cash investing and financing, which was that you purchased plant assets for $60,000, but you did it with a note. All right, so there wasn't any cash activity. Okay. All right, so using the following information, let's determine what the company's cash flows are from investing activities. So we can use the 3-stage process like we just went through. Identify the changes in investing related accounts, explain them using reconstruction analysis, and then report their cash flow effects. All right, so a factory with a book value of 100 and an original cost of 800 was sold at a loss of 10. So if we reconstruct our entry, we had a factory of 8, and we have a book value of 100, which must mean we have accumulation to date of 700, right? Cost less accumulated is book value. So our cost gets posted to the left side of our T account for factory, and our accumulated gets posted to the right side, right? So our journal entry, when we sell the factory, they told us that we sold it at a loss of 10. Our book value was 100, so that must mean our cash was 90. So we debit cash for 90. We have our loss of 10. We remove our accumulated depreciation with a debit because we have a credit balance here. And we remove our factory with a credit because we have a debit balance here, right? So there's our journal entry. So then our cash flow, our loss on sale of factory, it's a book loss. So that gets reconciled and added back to net income under the indirect method. And then you have cash of 90 received from sale of factory that belongs in your investing section of your cash flow statement. Okay. So then in letter B, we paid $70 cash for new equipment. Well, it's pretty easy journal entry, right? If we're going to reconstruct it, it's a debit to equipment for 70 and a credit to cash, right? So when we buy new equipment, when we buy long-lived assets, that belongs in our investing section of our balance sheet, or of our cash flow, sorry. And that's just going to be a reduction in our cash flow from investing activities because it's cash going out the door, credit. Okay. Then in C, our long-term stock investments were sold for $20, yielding a loss of $4. So we have to remove our investments off our books. So they tell us we get $20 of cash when we sell it. They tell us that we have a loss of 4, so that's a debit, which must mean that our credit to our long-term investment account is 24. And so if we were to report the cash activity related to this transaction, long-term investments are also in our investing section of our cash flow statement. And so we've made money because we sold stock. So that's an increase of $20. But then we also have to add back this book loss of $4 under our operating section or our adjustments to reconcile net income to net cash provided by operating activities. That's a book loss. That's not a cash related thing. But if we're starting at net income and we have to make adjustments for non-cash activity that is used in computing net income, we have to undo the effect of that basically. So you have net income, and in order to get to that net income number that we reported, we would have recorded both of these losses on the factory and the investments, and they would have reduced net income. So if I'm trying to get to cash activity provided by operating activities, I need to add those back because I'm starting with net income. Okay? All right, letter D, sold land costing $175 for 160 cash, yielding a loss of 15. Well, they told us what the land was that we got rid of, so we need to remove our land from our books for 175. They tell us we got $160 cash, so that would be a debit to cash for 160, and our loss on land for 15. So the cash we received for selling the land belongs in our cash received from sale of land. That's going to be an increase. We got cash, right? But then we also have to consider the effect of the loss, excuse me, on the net income, the net cash to net income reconciliation. So you have to add that back because it was originally subtracted from this net income number, which is your starting place. And you want to undo the effect of that because that $15 is not cash. It's just a book loss. Okay? All right, so to compute cash flow from financing activities, it's the same three-step process. We're just using different accounts, right? So we're identifying changes in the financing related accounts, explain them using T accounts and reconstruction analysis, and then we report the cash flow effects. So same idea here, except for we're looking at the financing related accounts now. So step one is to analyze the change in the account. So in this case, we have long-term note payable. And the change is from 64,000 up to 90, so it's a $26,000 increase. So in the additional information that was provided several slides ago, they told us in letter E that notes with a carrying value of $34,000 are retired for $18,000 cash, resulting in a $16,000 gain. So if we reconstruct that entry, they told us that the carrying value was 34, so we want to remove those from our books. They tell us the gain was 16, and they tell us that we got $18,000 cash, right? So there's our entry when we retired them. And so if we post it to the T account, we know from our balance sheet we started at 64,000. We took out a note that was 60,000, so we increased our note payable balance by 60. We retired 34,000 of that 60, so we need to reduce our note payable, which is how we get to the $90,000 ending balance. So the change, or the cash related activity, the cash related part of this transaction is this $18,000. So yes, our account balance changed by something different than that, but that's why you do the reconstruction analysis, because you're trying to find the cash piece of the transaction. So cash flow from financing activities, cash paid to retire the notes, we paid $18,000 cash. That's a reduction in our cash, so it's reported as a negative. Okay, so cash flow from financing, if we had a common stock transaction, let's say, step one is to analyze it. Step two is to explain the change, right? And step three is to pick out the cash pieces. So they tell us here that instead of giving us the balance sheet, they tell us in step one that common stock increased from 80 to 95,000. So that's a $15,000 increase. Step two, explain the change. So in item D of additional information that we got several slides ago, they say that 3,000 shares of common stock are issued at $5 par. So 3,000 times 5 is 15,000. When we issue stock, we credit common stock and debit cash, right? So here's our reconstruction entry. If we look at it in T account form, we started at 80, we issued 15,000 worth, and that's how we get to 95. So in this case, the entire change is cash related, right? So you have cash received from issuing stock in your financing section, positive $15,000. Okay. All right, so still in the cash flow from financing section, but if we look at retained earnings transactions, they tell us that retained earnings increased from 88 to 112. And they tell us in item F from several slides ago that cash dividends of $14,000 are paid. So when we pay the cash dividends, we credit cash and debit retained earnings, right? So we started at 88. We had net income of 38. They told us that from our income statement. And then we paid cash dividends of 14. So the piece that you want to pick up just for the financing section of your cash flow statement is a reduction in your financing section, cash paid for dividends of $14,000. So the purpose of the reconstruction analysis is because not always is the entire change in your balance all cash related activity. Does that make sense? Because you have 38,000 in net income, but not all of that is cash, and we're handling that in the operating section. All right, so the final step in prepping the statement is to report the beginning and ending cash balances that provide the net change. So you go to your balance sheet, you pick up your cash balance at the beginning of the year, or the prior year end, which is 12,000, and then you add to it your net increase or decrease, and you pick up your cash balance at the end. It should all net out. All right, use the following information to determine the company's cash flows from financing activities. So in letter A, the company issued common stock for $40 cash. So we're going to have an increase, $40, to our financing section. They paid to settle a note payable, and they paid $70,000 for that. That's going to be cash going out. In C, they paid a cash dividend of 15, so that's going to be cash going out. And then in D, they paid $5 cash to acquire treasury stock, so that's also going to be cash going out. So if we were to look at the journal entries related to these, in letter A, you'd have debit to cash, credit to common stock for 40. In letter B, you would have debit to note payable to retire it, credit to cash, so that's 70. In letter C, when we pay cash dividends, we reduce our retained earnings by $15, and we would reduce our cash by $15. And letter D, when we issue or acquire our own treasury stock back, we debit treasury stock and we credit cash. Okay. All right, so summary of cash flows is prepared by analyzing the changes in the non-cash balance sheet accounts, right? So all your balance sheet accounts that aren't the cash account. And then what this slide does is it uses T accounts to summarize how their non-cash balance sheet accounts affect their cash, right? Because oftentimes you're hitting cash and another balance sheet account that's not cash, something other than cash, right? So really this is just a summary of all of the activity in the cash account being posted to the various T accounts, the other side of the transaction, basically, because this is just cash. All right, so analyzing the statement of cash flows and applying the cash flow on total assets ratio. All right, so managers use cash flow for business decisions, creditors use it to evaluate the company's ability to pay their debt, and investors assess it before they buy the stock, right? So what is the slide trying to show us? So it's comparing the cash flow of the various organizations, BMX, ATV, and Trex. And what's interesting is they all have the same net increase in cash, but it's coming from different sources, right? All right, so cash flow and total assets used along with the income-based ratios to assess the company's performance. Cash flow and total assets is computed as operating cash flows divided by average total assets. Average total assets is beginning assets plus ending assets divided by 2. Okay. All right, so we are going to stop here. If you have any questions, please don't hesitate to reach out. Hopefully you'll find this helpful in preparing you for completing the homework that is due by 11:59 this coming Sunday. And p.m. that is, EST. And as always, if you have any questions, don't hesitate to reach out. Thanks, guys. Take care.